Tariffs can have both positive and negative effects, but here are some potential advantages for the US when imposing tariffs on China. 1. Protecting domestic industries. Tariffs make imported Chinese goods more expensive, encouraging consumers and businesses to buy from American manufacturers instead. This can help protect and grow domestic industries such as steel, technology, and manufacturing. 2. Reducing trade deficit. The US has historically had a large trade deficit with China, meaning it imports more than it exports. Tariffs can make American goods more competitive globally and potentially reduce the trade imbalance. 3. Encouraging job growth. By supporting American industries, tariffs can create and sustain jobs. In sectors like manufacturing and agriculture, companies that once outsourced production may bring jobs back to the US to avoid tariffs. 4. Strengthening national security. The US depends on China for critical technology and resources. Tariffs can encourage investment in domestic production of key industries, such as semiconductors and defense-related materials. 5. Negotiating leverage. Tariffs serve as a bargaining tool in trade negotiations. The US can use them to pressure China into fairer trade practices, such as stronger intellectual property protections and reducing state subsidies. 6. Diversifying supply chains. US companies may seek alternative suppliers from other countries to reduce reliance on China. This creates new trade partnerships and reduces economic dependence on one nation. While tariffs can raise consumer prices in the short term, they also offer long-term strategic advantages by strengthening US industries, protecting jobs, and giving leverage in trade negotiations. Would you like insights on how investors can benefit from these changes? Advantages for investors: diversification opportunities. The tariffs may encourage investors to explore markets beyond the US and China, identifying new growth areas and reducing reliance on these economies. Domestic market growth. Increased tariffs can lead to a focus on local industries, potentially boosting domestic companies that substitute for imported goods. Currency fluctuations. Trade tensions can cause currency volatility, presenting opportunities for investors engaged in foreign exchange markets. Policy shifts. Governments may implement supportive fiscal and monetary policies to counteract tariff impacts, creating investment opportunities in affected sectors. Supply chain realignment. Companies might restructure supply chains to mitigate tariff effects, benefiting investors in emerging markets or alternative manufacturing hubs. Get more insight from Simplify Finance,